the Financial Sense Midweek Edition with Jim Paplava. Delving in-depth with authors and experts into the key economic issues.
Hey, Bud.
Hi, Jim. Good to hear from you. How are you?
Hey, pretty good. What's on your mind today?
Well, I've been doing a lot of worrying about the European situation, and I've also been putting that in the context of the same kind of discussion that I think you may have been as early as I, a decade ago, of the perfect storm and mistrusting governments of the world in their ability to print up money for the Ponzi financial schemes that are creating havoc everywhere.
Yeah, what do you think of that LTRO program of almost, what was it?
530 billion euros, $700 billion, all in one day from the European Central Bank. What is this? It's printing up money at the expense of the euro in the longer term as they create more euros, and, of course, at the benefit of the big banks of the northern European countries that lent too much money to the weak southern European countries, and to bail out the whole scheme. The European Ponzi scheme, I think, is bureaucrats driven by bankers, and let the government and middle class and population and workers be damned. There's no consideration for the traditional values that you and I grew up with there. It's bought and paid for by the bankers, in my view. Anyway, that's my summary of that particular slice, and I think you're right to focus on it. That is, I think Europe is the lead horse in this troika of large government production of money, and they're the ones that's stumbling over the cliff and trying to hold it all together. So they're sort of the lead horse here.
You know what, Bud, is amazing is we don't count what the ECB is doing. They don't call it QE or money printing, but my goodness, they expanded their balance sheet by $1 trillion last year, now another $600 billion. And here's the funny thing. Bernanke's on Capitol Hill this week, as you know, on Wednesday and Thursday, and he acts like we're not going to do any more QE.
Huh.
And I'm looking at the budget deficits this year, Bud, of $1.3 trillion. Where in the heck are we going to get the money to pay for that stuff? We're talking about doubling the national debt in just 4 years.
Yeah, it's pretty amazing. And the sort of strange thing of the smugness of Bernanke is that he's sort of right. The dollar has not been crashing in the face of that deficit that you and I have been railing about, at least I've been complaining about for many years now, because it's even worse in China, Japan, and Europe, the troika of our competitors. The dollar is actually increasing little, not dramatically, against the comparatively even more profligate alternatives. So Bernanke can be somewhat smug, saying, I don't really have to do much right now, when in fact the government is causing the eventual printing of money to bail themselves out, because there isn't a good source of funding, not just the current deficit, but you've done these numbers. Retirement baby boomers of another $60 trillion unfunded liabilities over the next decade or two. It's a Ponzi scheme that will break in our lifetimes, I think. Yeah, go ahead. Jim, listen, you can talk to me and educate me as much as I can rant. This is a hugely important time.
Well, I was looking at the numbers because, I don't know if you've seen the number of tax hikes that are going into play next year. There's 7 of them, Bud.
Wow.
It'll blow your mind from, they're going to raise the top tax rate to 44% on a working stiff, an additional 4% tax on investment income for the first time. There's going to be tax on rents. They're going to be taxing. So we did some economic numbers, and then I looked at some studies that were done on what happens to an economy when you raise taxes like this. And I just didn't want to look at, let's say, Republican think tanks, but I took the president's own economic advisor, Christine Romer, who's from Berkeley, and I would hardly say Berkeley is a Republican bastion.
And Christine has been a talking head for the administration in her previous role, and generally smiley support for things wonderful being done by the current administration. What did she say?
She said that there's 2 kinds of taxes. She talked about endogenous and exogenous. And she said what happens is taxes are done for a number of reasons. Either one, to alter the economic outcome so that if, for example, the economy is in a recession or economic growth is anemic, you cut taxes to stimulate it. And on the other hand, if the economy is really heating up, like it was in the 70s when we had double-digit inflation, then you raise taxes to cool the economy down. And then there's what we call philosophical reasons, like the estate tax. It doesn't raise much revenue, but you do it philosophically because there's some people in this country that feel that if you work your entire life, you build up a business, the government should take 50% of it when you're gone. It doesn't belong to your heirs. So that's a philosophical one. But here's the interesting thing, Bud. She said that when you raise taxes by 1 percentage point, you lose about 3 percentage points of GDP. And the hardest hit sector, the sector that is hit the most, is investment. It really has a major impact on investment. And just like, for example, in Obama's stimulus in 2009, he created an incentive for, these corporate fat cats that he calls them to go out and buy a jet. They cut the depreciation on a corporate jet from 7 years to 5 years because they wanted people to go out to buy jets. Well, that's exactly what they did. The following year, they're demonizing them. But it's absolutely amazing. And then Art Lafler wrote a piece.
Art was a classmate of mine at Yale.
You're kidding.
No, I've got a lot of famous classmates. Not that many that I know that well, but yeah. But anyway, what did Art Lafler have to say? He's a conservative Republican kind of approach normally. I mean, he takes credit for what he called the trickle-down type of approach, supply-sider.
So what he did is he took a look at it. He said there have been 3 major tax-cutting waves in the United States. In the early 20s, under Harding and Coolidge, they brought the tax rates down from 77%, where they raised them in World War I, down to 25%. We got the Roaring 20s. And then, of course, as you know, Hoover raised them from 25 to 63, and then Roosevelt to 94, pretty much killed the economy. The second wave was Jack Kennedy, and unfortunately they were enacted after Kennedy was assassinated in 1964. And then the third wave was with Ronald Reagan. And what he did is took a look at, and this is very important, is what happened to government revenues, what happened to GDP growth, and what happened to the unemployment rate once the tax rates kicked into effect. And in all 3 categories or instances under these administrations, tax revenues went up, GDP growth expanded, and then the unemployment rate went down in every single case. And it's amazing that you've got a Democrat, Christine Romer, and that's probably one of the reasons I think, Bud, that she probably left the administration, because you remember in the early years of the Obama administration, he said, you don't raise taxes when the economy's weak. Well, now he's flip-flopped, and Romer's back at Berkeley. But so you had a Democrat and you had a Republican saying there's a point at which, and this is the Lafler curve, where you raise taxes and they get so high that you basically shut down all investment in the economy. And, of course, we know what happened when they got that high during the Great Depression. We had unemployment rates before the war that were over 20%.
Yeah, I think you and I sit on the same side of the table in general, that we'd like a smaller government with both smaller deficits, smaller spending, and smaller taxes, the whole group. That doesn't seem to be the trend worldwide. That's part of the bigger problem, I think, of Europe, in the sense that its huge social programs seemed to be free when they didn't do much in the way of defense, and ran what looked like improving economies when they increased trade among themselves, but didn't explain to everybody the huge trade deficits that are, I think, one of the big causes of the split between the rich and poor. The weaker countries had strong currency to buy imports and create big deficits. I got a little carried away here, but the point I'm worried about is generally big government. And the European answer is more big government, more debts on top of the debts to bail out the debts. And similarly here, when you started your commentary, you were talking about our deficit this year, $1.3 trillion. That is clearly unsustainable, can only be somewhat accommodated for a while by printing up money, and eventually will destroy the currency. Raising taxes is, I think, a poor solution, but clearly deficits are not sustainable, and something has to be done. I'd rather cut spending, but nobody wants their ox gored, whether it be a social welfare program or a military-industrial complex new gizmo. Everybody wants to spend, and the only way they can think of doing is printing up money, it seems. And you're pointing out now raising taxes, which I guess I hadn't looked at as close as you just have, to point out that that will be destructive for the growth of the economy, which will make the deficit worse, by the way, which is Greece's problem. Greece cannot be recovered because they've been told to have austerity. Austerity slows the economy, therefore it decreases the tax revenue, makes them require more austerity until they eventually say, enough, goodbye, we're out of here. I think Greece will do that. Maybe as soon as this next month, or this month now, March, I don't know when. Point being, back to the U.S., what's your thinking about the path of this unsustainable set of initial conditions right now?
You know, Bud, I'm looking at this, and our politicians have got to be aware. You just mentioned Greece. We told them, look, cut spending and raise taxes. Greece's GDP has contracted by 25%. The unemployment rate has gotten to be astronomical levels. Their budget deficits keep getting bigger. Yep. So I think they're going to opt out, and they're going to inflate their way out, devalue their currency. Yep. And I think that our politicians are going to do the same. I mean, I don't care if you listen to the president, he's already told you you're getting a free lunch, but he's saying if we can raise taxes on the rich, you can get a free dinner as well. So, I mean,
I think you're right on. I love talking to you. This isn't an interview, this is a conversation, and I'm learning a lot. Thank you.
Yeah, but it is, austerity doesn't sell. And so I think it's much easier. And I'm watching the Simpson-Bowles Commission, and there seems to be, Bud, there's 51 senators are for it right now. And what they might do is pull a Ronald Reagan and George Bush on us, and that is get together. They get rid of all our tax deductions for mortgages, charity, etc. In exchange for that, the Bowles Commission would have three tax rates, 10%, 14, and 23. And you remember, Bud, back in 1986 when Reagan brought tax rates down from 50 down to 28. And that was the year, I remember it because I used to buy tax shelters each year. And that got rid of pretty much tax shelters, writing off your sales taxes. And everybody said, okay, I'm willing to do that. Instead of paying 50, I'm going to pay 28. But what happened? Reagan leaves office. Bush, read my lips, raised tax rates to 31 and increased the Medicare tax on payroll. And then 3 years later, you get Bill Clinton, and he raises the tax rates to 39.6%, which was followed by copious money printing by Alan Greenspan. So I think basically when it gets down to it, this lines up with public opinion polls. I don't know if you've seen the Pew, the Wall Street Journal polls, but everybody agrees that you need to cut the budget deficit. Everybody agrees it's a major problem. But then when they zero in on the specifics, like, okay, would you be willing to take less in Social Security, Medicare, or pension? And then they get to what you say, nope, I don't want my ox scored. Gore, I don't know, the rich guy. So there doesn't seem to be widespread support for any measure of fiscal austerity, and I think the politicians know that, and that's why I think the policy going forward will be financial repression, which is just printing and printing and printing until eventually we print the deficit away or the system collapses. And I'm afraid this time, Bud, if they keep under this program because our debt levels are so high, I see no way of getting out of this other than heading to higher forms of inflation.
You've got it. I think and you and I, who've been saying that for a long time, have been a little bit unpopular in the last couple of years because, in fact, inflation has been fairly modest. That is, with housing prices actually declining and stock prices pretty much flat for a decade, it's hard to say inflation is wild. We've certainly seen high prices for oil and for gold and a good number of commodities, grains, copper, and so on. But they're somewhat hidden from the daily worries of most people, so they don't feel this as an inflationary environment. But what you said is that going forward, the only answer the government has for managing these huge discrepancies and unfunded obligations as well in the future will be printing.